From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce with my co-host Ren, and today we're unpacking the rising interest in fixed income investing amongst Australian investors and advisors and how we can all navigate this space. Ren, good to be with you.
Bryce, good to be with you as well. This feels like a very timely episode because, we've all lived through Liberation Day. We survived Liberation Day. But if you think about how equity markets have moved, we had an initial fall in Australia from Liberation Day. It was about 8%, but in the US, it was a double-digit fall in a week and a half. And then from there, the market has recovered and then some. Well, the US and Australia is both up from Liberation Day. Equity investors seem pretty calm about the whole thing.
They do.
And it had us wondering, in previous recessions, in previous financial crises, the bond market often moves before the equity market. Yeah. Maybe because they're naturally pessimistic in the bond market, and equity, to be an equity investor, you have to have some level of optimism. But often the bond market knows, as you said in your intro. So we wanted to speak to an expert fixed income investor to understand what the bond market was telling us at a time like this.
Today's expert is Jonathon Costello, Client Portfolio Manager, Australian Fixed Interest at Janus Henderson. And today we're going to be discussing what the bond market is actually telling us, where to for Australia, and then how to add fixed income to your clients' portfolios.
Now, a reminder that every episode of Basis Points is accredited by the Financial Advice Association of Australia for CPD points. So if you're an advisor, head to the link in the description or the show notes, follow the link, complete the quiz, we'll send you a certificate.
And make sure you subscribe to the Basis Points email, where each month we'll send you insights from Australia's largest community of retail investors, the next generation of wealth clients, so you can stay in touch with how they are thinking. A link in the show notes so you can subscribe right now.
Now, finally, before we get to the interview with Jonathon, we want to say thank you to our launch partners, SIBO, Milford and Orbis Investments, who have made Basis Points possible and help us keep all of our content free.
A special thanks today goes to SIBO. Ren, did you know Australia has more than one stock exchange?
We've been working with SIBO for long enough that I did know that.
Well, for those that didn't, you might have traded on SIBO without even realising it. With approximately 40% of all Australian ETF trading happening on SIBO, they understand the growing interest in ETFs among Australian investors.
Janus Henderson have recently listed JFIX, Janus Henderson Australian Fixed Income Fund, on SIBO. So we're going to hear more about the fund as we speak to Jonathon in today's episode.
All right, without further ado, it is time to bring in Jonathon Costello. Well, Jonathon, welcome to Basis Points.
Thanks very much for having me. And you got equity mates, but hopefully we can make some fixed interest mates as well.
So, look, equity markets have been pretty sanguine despite all the reasons for concern at the moment. What is the bond market telling us about what's going on right now?
Sanguine is an interesting word. I think if you close your eyes at the start of the year and then open them now, you'd see equity market prices. They've really had a good period and starting to approach all-time highs again in Australia.
It's crazy. We're up for the year. Yeah.
Yeah. It's been very volatile throughout the year, but close and open again, you'd think not much has happened. But in reality, there has been a lot that's happened, and the real headlines have been made through the US with Donald Trump coming out of the US, and he's done a lot and then flipped a lot as well. So it's created a lot of uncertainty in markets. Just by way of example, you've got middle of January, was sworn in, came and said, "Oh look, we're going to chuck in 25% tariffs on Mexico and Canada," and then just a week and a half later, he comes out and he says, "Oh, 30-day pause on Canada and Mexico tariffs," and then go through. End of the month, you've got him back on again. You've got him coming out whacking tariffs on China. And then we had the big Liberation Day tariff announcements where everyone was hit with 10% and China upwards of 140% or so. So who would have known that he'd be able to hop, skip and jump in that fashion, and then he turns them off 2 days later. So it's hard to guess, but it's been an interesting time in markets.
And so, as Bryce said, the equity markets, you close your eyes, you open them again, things are all right. What's the bond market telling us?
Yeah, the bond market, it has been seeing a bit of volatility as well. when you're looking at the pricing for interest rate cuts coming through, they've bobbed around a bit as well. The bond market's really grappling with whether inflation is going to be persistent or whether growth is going to fall off as a result of some of these tariff announcements and slowdown in economic growth. You're seeing in credit where above the risk-free yields, you demand a bit more compensation for risk. So credit investors have seen a pretty strong period of spread compression, so that the compensation investment demand has come off. But in more recent times, just with this uncertainty, people are demanding a bit more compensation for risk because they're not exactly sure of the path for economic growth.
So then why do you think the two markets are so disconnected? Like if we were to believe one market, the optimism from the equity market, or I guess the more reluctance or cautiousness from the bond market, who should we be believing?
Yeah, it's a good question. And I think even from a personal perspective, wind's been at the back in terms of some of the equity positions I've had in my own portfolio. And you start to think, this is all right. It's going well and I can lean into risk a bit. So perhaps the equity market, people are getting a bit complacent about the level of risk there. Some of the data hasn't started to deteriorate in the real economy. They're looking at that hard data. As a bond investor, you've got to be cautious. The key is to defend when times get stressful. You've got to have that defensive position in your portfolio. So I'd probably say, the uncertainty warrants caution. It's a good time to think about whether you need to add a bit more defense in your portfolios.
So we should believe the bond guys.
It seems like the classic situation where the equity investors are eternal optimists and the bond investors are eternal pessimists. But, maybe not. Pessimists might be too strong, but certainly are asking for more compensation for risk at the moment. Within the bond market itself, though, like within the different subsectors of the market, are you seeing any disconnect or any, different views expressed in some of the prices you're seeing?
Yeah, well, after the Liberation Day announcements in the US, there was a bit of market volatility enter. And you'd seen in credit in particular, you'd seen prices move upward and spreads come down. So people were really leaning into risk. Then in that period of volatility, you saw a bit more of a disconnect between market pricing and those high yield sectors in the market. Liquidity dried up a bit, and the high yield spreads or the compensation people expect, they shot up, so the prices went down. And then you saw in the defensive sectors, government bond lands, semi-government, they performed really well. Those defensive credit sectors, they did what they were supposed to do in that time of volatility, whereas, a bit of a disconnect in those times of volatile markets where, the riskier sectors sold off. So, amongst different sectors of the bond market, that's been interesting. Within the actual capital stack, within the banking system as well, you're looking at senior debt, subordinated debt, and then going down to hybrids, which are going to be no longer in not too long a time. But you're seeing relativities between those change quite quickly, and you're probably seeing hybrids pretty expensive just based on the investor base is dominated by retail in Australia. And they've really lent into that sector without probably understanding the embedded risk within that part of the capital structure.
Yeah, well, it's because they've had nowhere else to go for a while, and now they won't even have there to go.
Well, they've been seeking franking credits. They've been attracted to that. Mum and dad investors, but seeking defensive yield. It was an option for them to jump in and get a nice income coming through, but across the bond market now, as we all know, it was pretty painful with the monetary policy changes or the interest rates moving up pretty quickly. Now, bond yields across the board are much more attractive, and you can get the defense in your portfolio and get a really nice level of income come through.
So the bond market in past cycles has often been seen as the sort of early signal. Do you think that's the same this time around? What should we be watching for?
Yeah, I think bond market investors, they do have a lot of data to react to. They're closely keeping an eye on inflation and employment. There are a couple of key market signals that they're watching. They're also looking at some of the softer data that's not hitting the real economy, sentiment, consumer sentiment, business sentiment, inflation expectations. So there's a lot to digest, that's for sure. It's bond markets, a bit of a signal. If you see yields rally, so expectations for rate cuts coming through to support economic growth, it's often a bit of a signal that perhaps equity markets, they've had a bit of a rosier time with some stronger economic growth. It might slow, and then economic growth does slow and equity prices start to come off. So it is true, bond markets can be a bit of an early signal. Bond yields definitely lead cash rates. So if you're waiting for cash rates to fall and thinking that your bond portfolio is going to rise, it might be a bit too late. So keeping an eye on the bond yields is important.
Well, speaking of cash rates, let's turn to Australia, and it seems to be a national pastime, a national obsession to speculate on the future direction of cash rates. What's the bond market telling us at the moment?
It has moved around a bit in Australia over the last couple of months, but when you look at the implied policy rates, which you can get a sense of that through interest rate futures, so market participants agreeing to buy an underlying asset at a certain price at a future date. They're buying a government bond in this circumstance where the interest rate that they're setting in the future is set. So you can get a really good idea of where interest rates are expected to go. So when you're looking at that in the market at present, it's around 3 cuts is priced in over the cycle. Perhaps a little bit more than that at present. Bobbing around a bit, but for the people at home, if you're thinking about how large a mortgage you've got and you're offering a bit of relief on your mortgage, you're probably looking at mortgage rates getting down to high 4s or low 5s. So definitely for those that were smart enough to get their sub 2% fixed rate for 5-year period, they wish they could fix it for 10, I think. But a bit of relief there, but probably not everyone running out onto the streets and spend again if they've got any extra capacity, because mortgage rates aren't going to drop to those levels that they were a couple of years back.
Yeah, they were an anomaly. Yeah.
Yes. I mean, if we get in the 4s as well, you can only imagine what that's going to do to house prices as well. So Australia's government debt is going to be ticking over near $1 trillion this year. The S&P have warned about our AAA credit rating. So what are you seeing in the Australian bond market, Australian government bond market? Do you have any concerns?
No, the key concern would be if the government bond yields were really selling off, not in sync with other regions. So Australia, it has been telegraphed that reaching up $1 trillion worth of debt, and S&P did make a bit of a warning prior to the election. The concerns about perhaps some unfunded promises made by either party. So keeping an eye on, you've got to make sure you're keeping that in check. But when you're looking at the actual gross debt, it's expected to get up to $1 trillion by September of this year. But when you're looking at net debt, which you're taking into account some of the assets across Australia, such as the Future Fund, it's actually a fair bit lower. It's about $550 billion. So when you're looking at that and you're looking at Australia relative to other regions, debt to GDP, it's around 50%, let's say, just simple terms, versus some other developed market economies, such as the US, it's up at 120. You got Japan closer to 250. It's pretty manageable. Australia, there's been a couple of budget surpluses, not forecast to be in surplus over the next couple of years from the latest budget forecast, but in a pretty good position on a developed market, advanced economy, and our AAA rating is indicative of that strength. But I'd say to keep an eye on concerns, you'd say, hey, look at the market issuance. They've been well bid, and there's a bit of supply, but been well bid in terms of market liquidity.
On the credit rating stuff, news earlier this year was around Moody's cutting the US from AAA to AA1. Does the credit rating change? Does that change your view on like the underlying asset, in this case like US Treasuries, or does it not have much of an effect?
I've had a bit of a look through to the global colleagues, and the expectation is it's not going to have a huge impact upon the pricing of US debt. The downgrade by Moody's from AAA to AA+, that actually brought the credit rating agencies into sync. So there's 3 major recognised credit rating agencies. There's Moody's, Fitch and S&P. And when you look at those rating agencies, Fitch downgraded the US debt in 2021 and Standard & Poor's was in 2011. So they've come into sync. You've looked at market pricing over the last 6 months in particular, and some concerns have started to come through around the US's fiscal position and the amount of spending they're doing. There's a lot of moving parts, of course, with all these tariff announcements and trying to get that right and cut some expenses. But then, the impact upon borrowing costs for the US a bit more of a concern for the market. So you've actually seen the back end of the yield curve. So investors investing in longer dated US Treasuries, the compensation they're expecting for lending for that longer period of time is the term premium. That's shifted up a little. So might have been already priced. There could be at the very margin some impact just on sentiment, but I think a lot of that was priced, and it wasn't altogether too surprising.
What are some of the most important signals or instruments that you're watching on a daily, weekly, monthly basis? If you could sort of only watch one, which one would you be choosing?
Only watch one. It's a difficult one.
That's the question.
That's a question. Well, if I could answer the question a roundabout way, I think central bankers, they're looking at inflation for the most part, and then employment. And in recent times, the chair out of the FOMC has come out and said, hey, or the Federal Open Market Committee has come out and said, hey, we're going to focus on inflation in the near term just because of the uncertainty around the impact on tariffs. So that is most critical in terms of where bond yields are going. Then as investors, active investors, we're trying to look at the whole set of factors, market data points. We're looking at those hard data points, but also sentiment indicators and insolvency data, or just really trying to have a laser focus on fundamentals within credit sectors, but also what's affecting the real economy. So a very difficult question to try and focus on one, but in times of crisis, one of the things that as an active investor, Janus Henderson has a really good record of doing is actually supplying liquidity when markets need it. So we see opportunity when people are panicking. We're very, very disciplined in leaning into risk at the right times. And we've been able to deliver some really outsized excess returns for investors when liquidity starts to dry up. We can be a liquidity provider to the market in that environment, and ends up, because we've been disciplined before, we've got a bit of dry powder, and we can lean into the areas of the market that have sold off against fundamentals being still pretty rosy, and it looks at being pretty good value play. So liquidity in times of crisis is absolute key, but definitely it's hard to single it down to one.
We're going to take a quick break here to say a massive thank you to SIBO for sponsoring this episode of Basis Points.
Here's something that you might not know. Australia actually has more than one stock exchange. And if you've ever bought an ETF, there's a good chance that you've already traded on SIBO Australia without even realising it.
In fact, around 40% of all ETF trading in Australia happens on SIBO. It's clear they're right in step with the growing interest in ETFs amongst Australian investors.
So next time you're investing, keep an eye out. You might be trading on SIBO again.
Well, speaking about Janus Henderson and how you invest, part of the reason you're here today is because you have a SIBO listed active ETF, JFIX. And we want to talk about, I guess, like how investors and advisors can add fixed income to a portfolio, because I would hazard a guess that for most of the last decade, the majority of people listening to this were underweight bonds. Like fixed income, you were pretty unloved in the scheme of things. On one hand, you had Mag 7 ripping. On the other hand, you had, almost zero rates for most of the 2010s. But things are changing. And are you starting to see that change in the sentiment you're hearing and the conversations you're having with clients?
Definitely, yeah. I have seen a return to some allocations towards fixed interest, fixed income, as also known, and credit as well. And over the last couple of years, after a bit of a painful period in terms of core fixed income, where interest rates were moving higher quickly, and those markets sold off, a lot of people have talked about those defensive characteristics having come back to the fore. And one of the old sayings now, everyone's saying bonds are back. I think the way I'd term it now, when you're talking about fixed income, the income is back in fixed income. And when you're looking at fixed interest, if you want to call it that, the interest is back in fixed interest.
Nice.
So, I'd say, the income's come back. You've got that nice defensive yield coming through. You don't have to really go right down the capital structure or up the risk spectrum to try and get that yield that you're looking for in your defensive portfolio. And, of course, when you're doing that, it's not as defensive. So you can go into these core bond funds such as Janus Henderson's Aussie fixed interest fund, and you can get your defensive characteristics where in times of stress, then your government bonds, semi-government bonds, they rally. But then you can also diversify across lots of different areas of the market, which are very attractive on a relative sense versus offshore markets, which I can touch on. And get your defensive income yield and maintain that liquidity with your total portfolio.
We imagine that, I guess, a lack of interest may have led to a few misconceptions among clients. What are some of the misconceptions that you find most frustrating that I guess now you have the platform to address?
I think the answer to that, there's a lot of choice within fixed interest, and a lot of those investors out there, they get a bit confused and they don't realise that there's lots of different sectors of the market, and not all fixed interest is the same. It's very broad church. So there's area of the market you can lean into and lean out of, and for some investors that perhaps don't understand the asset class so well, they're pretty surprised with some of the returns that they got through the post-COVID period, but not realising that, in fact, there wasn't a lot of yield to offset the capital price movement. So now, if you were looking at past returns, you might think, oh, geez, that's a tough period. But now you've actually got these nice yields built in that it's a lot harder to get those sorts of negative returns, and we've got a pretty nice forward-looking outlook in the market. As an active investor, there is a lot of choice in the market, and we do lean in out of different sectors at different times. When yields are selling off or rates are selling off, then credit can perform a really good role in portfolios. You have nice income coming through, and you can have floating rate credit, which actually moves, the yields move up in line with cash rates or yields moving up. I think the misconceptions are things are all the same and into one bucket, but there's lots of ways that you can navigate the market. That's why active management's important.
Well, to illustrate that, if there are lots of buckets, what's the bucket that you're finding the most appealing at the moment across the Australian landscape?
Well, the most appealing, I think, in the times of crisis, it's government bonds, semi-government bonds. They have offered value where you do have that liquid portion of the market, and they have rallied in times of stress. Credit has been an area that's been in favour for the market. Fundamentals are pretty strong in Australia, and people have had a look and said, hey, look, we're attracted to the spreads. But spreads have moved quite a lot tighter versus where they were, say, 5 years or so ago. So we do favour that nice level of income through our credit positions, but we do like to take bigger positions in safer things. We've got a laser focus, as I mentioned before, on defending, making sure that when you're looking at your asset class allocation, you want to be defensive, you want that nice income coming through, but you've got to have diversification. So we're diversified across sectors, government bonds in portfolios, semi-government and credit, and we're moving it around just to try and make sure that we're trying to deliver those attributes that people are seeking in the portfolios.
Nice. So as Ren said, you've just launched JFIX on SIBO. What makes now the right time to bring a core bond ETF to the Aussie market?
Yeah, it's a good question, and I think that, as I've mentioned, there's a lot to think about within fixed interests, and core bond fund does deliver those defensive characteristics. It's not leaning into any one area of the market. It's well diversified and very defensive. In line with fixed income being a broad church, Janus Henderson is a full spectrum manager. And what I mean by that is we've got expertise across all areas of the market. Got a long pedigree. In Australia, we've got a fixed interest team that's been running Aussie core fixed income products for 30 years and has been delivering some alpha through short, medium, long term. So, yeah, thinking about core bond funds when there is that uncertainty that we talked about a bit earlier, and a lot to think about, and equity market valuations, they're definitely not cheap, a bit extended. You're looking at forward-looking returns, and they look pretty nice coming out of the fixed interest bucket. Forward-looking returns based on where equity valuations are. Through historical analysis, you could say they probably aren't going to be as rosy from here. Everything has to go right, really. You've got to have a lot of earnings growth, and if earnings growth is slowing down, if the economy is slowing, it's going to be pretty hard to get this really strong earnings growth, or people have to pay even higher prices for each dollar of earnings. So, whether they'll do that, it'll be up to sentiment and people's appetite. But core bonds, they do offer that defensive opportunity within your portfolio, and now with all this uncertainty, there's probably a good time to have a look at some of your allocations.
Yeah. Well, I think a lot of people are looking at their allocations for a lot of the reasons that you've touched on today. Yields are back higher, and there's certainly more chat around fixed income or fixed interest. But with that has come a bit of a surge of ETF listings. I don't know if you'd call it a surge, but we're seeing more and more fixed income ETFs come to market. So I guess how is JFIX different? How should we separate that from some of the other options available?
Yeah, there has been a bit of a surge, but I'd note that a lot of them are passive. And people have been looking to the asset class to say, hey, look, this actually looks attractive again, and we can get those nice forward-looking returns, defensive characteristics. But there aren't that many active fixed interest ETFs that are listed on the exchange. Now, when you're looking at fixed interest in Australia, there is a really good record of the median manager outperforming the index. So it's not quite the case in equity land. It's pretty hard to beat the index. There's weighting differences. The biggest, best companies, they keep growing and growing, and they're a larger proportion of the index. In fixed interest land, the benchmark's set up a bit differently. Those that are most indebted, they get to be the biggest. So whether they should be the biggest part of your portfolio is open to question. Yeah. But all in all, active fixed interest has delivered, on average, better than the index. And if you're taking that as a given, then you've got to look for a manager that is active but also has a record of success. So JFIX, it is based on a 30-year track record, and as I mentioned, we've been able to deliver upon our objectives. We target 60 basis points in excess of the index, and we've been able to do that over short, medium, long timeframes. But beyond that, when you're looking at the different parts of the market, there are lots of different areas that you can add alpha, or the ways you can deliver that excess return versus the benchmark. And we've got a really strong record of delivering from lots of those different alpha factors. So could be in your interest rate positioning, which is pretty difficult to get right, but we've done that over time. It could be in your sector positioning, allocating to credit. There are a fair few managers out there who they do lean into credit and get that nice additional income come through, and it can be a bit more volatile through periods where credit spreads widen or tighten. But we try and be that full spectrum manager with areas of expertise, but also active in every way. So we look at interest rates, we looked at sector positioning, we look at inflation and see if we can build some inflation protection in. And we also put in a bit of portfolio insurance through credit default markets. So credit default swaps, you can think of it like having a bit of insurance against some offside impacts in your credit allocation.
I think we all learned what credit default swaps were from Margot Robbie and The Big Short. I think GFC woke everyone up to what it was. Yeah.
Well, Jonathan, that brings us to the end of today's conversation. Thank you so much for coming in. We've certainly learned a lot about what's going on at a macro level and how that's flowing through to the bond market. So we'll put a link in the show notes to the landing page for JFIX. Congratulations on the launch. I'm sure there are a lot of advisors and everyday investors listening who are now hopefully considering it as part of their mix. So thank you so much. We really appreciate it.
Thanks very much for having me.
Thank you.
That brings us to the end of today's episode. A reminder that all of the content here at Basis Points is approved by the Financial Advice Association of Australia for CPD points. All you need to do is follow the link in the show notes, complete the quiz, and you'll get your certificate.
And if you want more from us here at Basis Points, don't forget our monthly Basis Points email. We're sharing insights from the broader Equity Mates community to help you better understand your next generation of wealth clients.
That's it from us here at Basis basis points. Thanks for listening. We'll see you next episode.